What if I told you that choosing between stocks and real estate could be the difference between a comfortable retirement and generational wealth? By the end of this video, my hope is that you have a clear picture of which option fits your goals and know exactly how to get started. We're going beyond the typical head-to-head where someone just compares the average historical rate of return of the S&P 500 versus the average rate of return of real estate and leaves it at that. Anyone could easily just look up those numbers, and even then, they don't reflect current economic conditions or how an actual human would invest over time. So I've built a comparison tool that I feel is more representative of how one would actually invest in either real estate or the stock market if they were starting out today. And it'll help illustrate how much money you could potentially make by continually investing over 5, 10, or even 40 years. So if you haven't realized already, it takes a lot more money to start investing in real estate than it does in stocks. Heck, if you wanted to, you could hop on Robinhood right now and buy $1 worth of Apple stock and you would technically own a piece of that company. On the other hand, a 20% down payment plus closing costs on an average priced $350,000 house in the US is about $73K. And depending on where you lived, that initial upfront cost could be a lot higher. So if real estate feels out of reach for you right now, especially with where mortgage rates are at, then the stock market is a great place to get started with investing. If you need at least a few years to build up a down payment for a rental property, then one option is to park that money in an index fund until you reach your goal for your down payment. You might even be able to reach your down payment goal faster this way, depending on the growth of the market over that time. But if you're close to being able to buy a property, or you don't feel comfortable risking your down payment to the swings of the stock market, then it's totally fine to keep it in a high interest savings account until you're ready. It's all about finding your starting line and making the race work for you. But let's say that you are at a point where you can safely afford a piece of real estate. And for the sake of our example here, let's say it's a single family home priced at $350,000. Don't get too hung up on the discrepancy between the average US home price and the home values in your area, because the principles in this video remain the same. The current median rent for a single family home in the US is $2,600 a month. And after accounting for a 5% vacancy rate on long-term rentals, we get an annual rental income of $29,640 in the first year. As far as expenses, our 30-year mortgage at a 6.8% interest rate comes out to $1,825 a month, or about $19K for the year. Your mortgage interest rate will definitely impact your mortgage payment and thus the profitability of your rental, so keep that in mind. A higher interest rate means you'll have a lower profit margin and an overall lower return. After adding in property taxes, insurance, and a yearly maintenance cost of 1% of the home value, the total expenses in year one are $30,589. And you might be thinking, wait a second, my expenses are greater than my rental income. So how is this a good investment? Well, you've got a point. Current interest rate levels combined with home prices that are still near record highs make the cost of ownership quite expensive, especially when you look at how low rents are compared to the total monthly cost of ownership. When combined together, current interest rates, home prices, and rents make it very difficult to find residential properties that produce positive cash flow right off the bat. I can speak from experience that it's near impossible to find a piece of property that generates a profit where I live in the Bay Area of California, since the monthly cost of ownership is often over twice the cost of rent. However, getting back to our example, just because our cash flow is slightly negative in the first year doesn't mean it will remain that way forever. As long as our area isn't rent controlled, we can reasonably expect the rent that we can collect to grow 5% per year based on historical trends. But we have to remember that many of our expenses also increase each year. Luckily, our mortgage payment is fixed, but everything else will increase approximately 2% every year. The nice thing here is that the rent we're charging is increasing at a faster rate than our expenses, so we'll make more and more profit each year as time goes on. It's also important to note that there are tax benefits when you're a landlord, but those benefits are generally only enjoyed once you're making a profit. So eventually, once we achieve a positive cash flow, we can lower our taxable income by deducting mortgage interest and property taxes, as well as by depreciating our property over 27.5 years. So if we were only looking at cash flow, especially our slightly negative cash flow in year one, then residential real estate wouldn't seem like that great of a deal. But thankfully, real estate investors also get to enjoy the additional equity they build through appreciation in home values over time. And historically, that appreciation rate averages 4% per year. So when we add together appreciation and cash flow, after 10 years, we've made a net return of about $264,000 on our initial cash invested. At 20 years, our net return goes up to $860,000. And after 40 years, our net return reaches $4 million. Not bad, right? Next, let's compare our real estate return to the gold standard that everyone likes to compare to, the S&P 500. So instead of a rental property, let's put all that cash you paid for the down payment and ongoing expenses into an index fund like SPY or VOO that matches the performance of the S&P 500. So whatever you were paying towards the mortgage, property taxes, etc. each month for 40 years, is now going into the index fund. We're assuming an 8% annual rate of return for the S&P 500 based on the historical average. So in this scenario, after 10 years of investing in an S&P index fund, you'd have $648,500 versus the $264K for your rental property. After 20 years, our net return is $1.93 million compared to $860K. And after 40 years of continually investing in an S&P 500 index fund, you could have $10.5 million compared to only $4 million from your rental property. Yeah, so why would anyone ever invest in real estate when the net return from the S&P 500 is so much higher? Well, no one said you only have to invest in one rental property over the course of 40 years. What if after several years of collecting cash flow from our first house, we decide to buy a second single-family home and rent it out? In our example, let's say we've saved up enough money to buy another $350,000 house in year 8, so let's do it. Now after 40 years with 2 properties, we can make $6.5 million in net return. And the other benefit of having 2 properties is that the combined cash flow after a few years is higher, so we can build up cash faster to buy a 3rd property. After 40 years with 3 properties, we're looking at $8.1 million in net return. We're getting closer to that $10.6 million we got from the S&P 500, and I'm sure you can see where I'm going with this. So what does it look like with 4, 5, or 10 properties in our real estate portfolio? Well, in this scenario, after 40 years with 10 properties, you're looking at a net return of about $15.3 million. That's about 50% higher than the total net return of the S&P. So the tables have turned a little bit, and now real estate is looking like the winner compared to stocks when it comes to potential return. However, I can't go on any further without acknowledging that there is a massive difference in the amount of work between acquiring and managing a rental property, let alone a portfolio of 10 houses, versus the hands-off, passive nature of index fund investing. Yes, you can hire a property manager to offload a lot of the work when it comes to maintaining your rental operations, but that will definitely add a lot to your ongoing expenses and negatively impact your overall return. So just keep in mind that real estate investing is not passive, even if people online make it seem that way. I also want to highlight that the reason why we're able to increase our potential return in real estate so much over the S&P 500, even though we start with the same amount of cash, is because of leverage. In the example I've described so far, we're controlling a $350,000 asset by leveraging initial cash of only $73K. The resulting 80% loan-to-value ratio, or LTV, after putting 20% down, is considered relatively safe when it comes to real estate investing. But a lot of real estate investors really over-leverage themselves. They risk losing their properties by doing things like cash out refinances on their current properties to go out and quickly build up their portfolio. But that type of over leveraging, where you might have a 95+% loan to value ratio, is a lot more risky, and I can't recommend that type of thing here. So up to this point in our comparison, a relatively attainable real estate portfolio of 10 single family houses has beaten an S&P 500 index fund in terms of potential return. Granted, it's going to be a lot more work. So if we were to stop here, you might leave this video thinking that real estate is for sure a better investment than the stock market. But let me remind you that there are other common index funds that you can invest in just as easily as the S&P 500 that have a historically higher average rate of return. Just take a look at the performance of the NASDAQ 100 over the last 40 years. The average rate of return is basically double the S&P 500 at 16%. I'm not talking about anything crazy here like putting all your money in individual stocks. I think that most people would agree that an index fund like QQQ, which tracks 100 of the biggest companies in the NASDAQ, is a relatively reasonable place to put your money. It includes household names like Apple, Amazon, Costco, and Starbucks. Yes, the magnitude of the price swings of the NASDAQ 100 are greater than the S&P 500, but the historical returns are also much greater over the last 40 years. So in my comparison, if instead of putting all of our money in an S&P 500 index fund like SPY, we instead put it in a NASDAQ 100 index fund like QQQ, then after 10 years, we get a return of almost 1.1 million. After 20 years, our return is 5.7 million. And if we can consistently invest for 40 years in something with an annual return as high as the NASDAQ 100, we could potentially see a net return of $115 million. That's 10 times higher than the return we got from the S&P 500 index fund and about 7.5 times higher than the return we got from the 10 rental properties. And we didn't really have to work for it. And I know that 115 million might sound like an insane, unattainable number, but that's just the incredible result of compounding at a 16% rate of return over a long period of time. Now, there's no rule that you have to go 100% with either real estate or stocks. In fact, it's not a bad idea to diversify your investments to enhance your portfolio's resilience against market volatility. Personally, I'm about 50-50 in terms of my net worth. And I have to mention that I acquired my rental property when interest rates were much lower than they are now. And I'm operating it as a short-term rental, which typically generates more income than a long-term rental. Both of these factors have a huge impact on its profitability. If I were to buy my current property at today's interest rates or rent it out on a long-term basis, the numbers would not make sense for an investment. In fact, I'm not looking to invest in any additional real estate until the numbers start to look more favorable. For me to consider jumping into more real estate, interest rates or housing prices would have to come way down or rents would have to go way up. So with that said, I'm leaning more towards putting my future cash into something like a NASDAQ 100 index fund so that I can focus more on my business rather than on managing multiple properties. But we'll see. I'm pretty opportunistic, so I could see myself jumping on the right real estate deal in the future if it presented itself. It's likely that at some point in the future, as interest rates, home prices, and rents adjust, real estate may become a lot more lucrative investment than it is right now. So like any model, my comparison tool is not perfect. I hope it's given you some new insights and ideas about investing, but always consult with a financial professional before you make any decisions. It's also important to note that no investment is guaranteed to continue to follow historical trends. We can only look to the past to help guide our decisions in the future. And finally, there are tax implications in all of these scenarios that I can't speak to because I'm not a tax professional. So it's always good to consult with a CPA before you make any big financial moves. If you want to see more next level real estate and investing content with in-depth analysis, make sure to subscribe and let me know what other topics you're interested in covering.